Today, what we're going to be discussing is Chapter 11 of our text, and it is dealing with current liabilities and payroll accounting. So some of the things that we're going to talk about today, we've touched on in earlier chapters. We're going to taking a little bit more of a deeper dive into exactly what's going on in terms of how current liabilities, remember that there's current liabilities and there's long-term liabilities, and also dealing with how we do payroll, which actually should be pretty interesting for you because I'm sure, we all work, we all get a paycheck. So we'll discuss how the amount that we receive is calculated. First, what we will do is we will describe current and long-term liabilities and their characteristics. If we remember back to the very beginning, to what we studied in August and in September, we learned that a liability is a probable future payment of assets or services that a company is presently obligated to make as a result of past transactions or events. This definition includes three critical factors: either a past transaction or event, a present obligation, and a future payment of assets or services. So it could be that we ordered merchandise on credit, so then we receive the merchandise, we have to pay cash for the merchandise. It could be that, but it could also be that somebody has paid us for a service, maybe to do some consulting for them, or example is also could be like to do some work for them. So for example, the HVAC company that we use, we paid for them to come in the spring to check the cooling aspect of our system, and then they're supposed to be coming anytime now to check for the heating portion now that we're in October going into November, so we're going to have to start using the heating. But we paid for that all at one time. So that was a liability then that was created on part of the HVAC contractor. So it could be that they either owe services or cash money. Now there are two types of liabilities. We have current liabilities and long-term liabilities. Current liabilities, also known as short-term liabilities, are liabilities that are due within 1 year or the company's operating cycle if it's longer. Most are paid using current assets or by creating other current liabilities. So we said it could be either paid with cash or maybe creating some kind of a notes receivable. Current examples of liabilities could be accounts payable, short-term notes payable, wages payable, which we've talked about, warranty liabilities. We'll talk about that today. It's about warranty liabilities, taxes payable, and also unearned revenue, like we've discussed. Now, long-term liabilities are liabilities that are due after 1 year or the company's operating cycle if longer. Now, long-term liabilities could include long-term notes payable, warranty liabilities, lease liabilities, and bonds payable. They are sometimes reported on the balance sheet in a single long-term liability total, or they could be listed out in separate categories. On this exhibit, Exhibit 11.2 shows current liabilities as a percentage of total liabilities for selected companies. So we see here that current liabilities are due, as we said, within 1 year or the company's operating cycle if it's longer. Usually it is just a year. And then long-term liabilities are due after 1 year or the company's operating cycle if it's longer. And so we see, for example, we see here that Columbia Sportswear, they make jackets and different backpacks and different types of things. We see that they have $363 million of what's considered current liabilities. That makes up about 83% of their liabilities. And in Bowl America, they own bowling alleys, is about 3.3 million, or about 58%. So they have a lot more in terms of probably longer liabilities. And so it probably would be like mortgages on maybe their bowling alleys, or maybe long-term accounts payable for and notes for the machinery, that's used in a bowling alley. Apple, we see, has 79 billion in in current liabilities, so 41%. And then Six Flags has 316 million in current liabilities. That's about 14%. Obviously, again, they're going to have the rest of it then will be longer term things. Again, mortgages on probably on their parks, notes maybe on some of the different amusements maybe that they're still paying for, et cetera, et cetera. The uncertainty of liabilities. Accounting for liabilities involves answering the three questions: whom to pay, when to pay, and how much to pay. Answering these answers are often decided when the liability is incurred. So it's when you first do whatever it is. So for example, if a company has $100 accounts payable to a specific individual payable on March the 15th, the answer is clear. The company knows who to pay, when to pay, and how much to pay. However, the answers to one or more of these questions are uncertain for some liabilities. So sometimes you won't, it's a little harder then to tease out, or there's things that maybe you don't know at that point if it's going to be a liability or not, and you'll discover that later. Identify and describe some known current liabilities. So most liabilities arise from situations with little uncertainty. They are set by agreements, contracts, or laws and are measurable. These liabilities are known liabilities, also called definitely determinable liabilities. Known liabilities include accounts payable, notes payable, taxes, payroll, unearned revenue, and leases. Okay, so these are all examples of liabilities that we know we are due, and we know that they're due within the year. So let's talk about sales tax liability for a minute. So if Home Depot sells materials on August 31st for $6,000 cash that are subject to a 5% sales tax, the revenue portion of the sale would be recorded as shown here. Sales tax payable is debited, cash is credited when it's remitted these collections to the government. Okay, so usually sales tax usually is due to the state, and then the state then would divvy it up then because the county gets a portion, the city gets a portion, and also the state gets a portion. And so if you've noticed that, like around here, you've probably noticed in your travels that, for example, Merced, I think is like 8% or something. I know Atwater, it's a little bit higher. I know for Winton, it's 7.75 because the base is 7.25, and then they add, some of the cities have done different things. And so I know Merced, I know Atwater has done, raised their sales tax in order to fund the police and the fire department and some of the things, with that, and as have Merced. So part of it goes to the city, part of it goes to the county, so Merced County, and then part of it goes to the state. So again, if we make a sale, you have cash debit in the amount of $6,300 because that's the amount that you're receiving from the customer. Then you have to credit sales $6,000 because that's the amount, let's say, of lumber that Home Depot sold. And then we have to also then credit sales tax payable, which is, in this case, at 5% of $6,000 is $300. And then, of course, you'd have to also then debit the cost of goods sales and the inventory, of course, the credit inventory for cost of sales of the sale. Now, and as I say, when you pay it, usually you pay it every quarter or every month, but usually it's every quarter you pay it. You would debit the sales tax payable, which is the liability, and then you would credit cash, which is the asset when you're paying it out to the state. So now unearned revenues, and this kind of gets back to the example that I gave with our HVAC company, where we pay them for service before they actually perform the service. But in this case, we're talking about a concert venue. So unearned revenues are also called deferred revenues, are amounts that are received in advance from customers for future products or services. Advanced ticket sales for sports events or music concerts would be an example. And so kind of to give you kind of an example, kind of silly, but an example, is me and Amber, my girlfriend Amber, we went to see a concert in Fresno at the Warner Theater there. It was a Christian artist that her and I both like, named Mandisa. Okay, so we went and saw her. Well, we purchased the tickets ahead of time. Oh, I think on that, I think Amber did. So she purchased the tickets ahead of time, and then we drove down to Fresno to the Warner Theater to see her in concert. And it was it was very nice. Now, true story. Let's say that something happened, and let's say that Mandisa got sick, and she couldn't come. She couldn't do her concert. So they would have to do something. Once she does her concert, she earns the revenue. Well, not her, but the concert promoter earns the revenue and then would pay the theater for having it there, etc. Okay. But in advance, the concert promoters received the cash for the tickets, but they haven't provided the service yet until the concert's given. So the first one is the sale, showing the revenue for the tickets, and then sales, and then once the concert then is performed. So we see here that Selena Gomez, she sells 5 million in tickets for a 8 concert tour. The entry is shown first, is at the top there. So the concert promoter, or Selena Gomez, she receives cash of $5 million, debit, credit unearned ticket revenue, because she's not performed these concerts yet. Okay, so now once she performs the concert and it's played, and let's say she gives one of her concerts. Okay, so when a concert's played, Selena can then record revenue for the portion that she earned, so 1/8, because she gave one concert of the 8 total that are part of the concert tour. So she then earned 1/8 of that revenue in October. So the tickets were sold in June, and then on October 31st was the concert. So once she does that, then she can debit the unearned ticket revenue, $625, which is 1/8 of 5 million, and then she can then record a credit to ticket revenue of $6,250. Okay, and so then she can then do that, and then she can actually spend that money, because before that she hasn't earned it. And then the case being, as I say, if let's say the concert is canceled, they would either have to give another concert and reschedule it for another time, or they would have to issue a refund. So again, so you have to have that money there, and that's why we do this. Unearned ticket revenue is an unearned revenue account, which again, it's basically a liability, and is reported as a current liability. Unearned revenue also rise, we know, from airline tickets or Amtrak tickets. Magazine subscriptions is another one that we see this a lot with. So let's say that I know for us, my mom, she takes a magazine called Taste of Home, which is a cooking magazine. Well, we pay for it, for, I don't know, a year and a half, whatever it is. And they send us every 2 months, they send us a magazine. They can't spend that money until they've issued that magazine. Okay. Or so they do the same process. Construction projects would be another one. So for example, we had our HVAC system worked on, and let's say that we paid up front for that, or we paid a deposit for that. They couldn't earn that deposit until they've actually done the work. Okay. Hotel reservations, gift cards are another one, and custom orders. Gift cards, that's one that you see a lot, is with gift cards. And again, there's a float there. I don't know if you've heard of this term, float. And so that's what happens. Let's say that you buy a Starbucks gift card, you're going to give it to somebody. Well, if they still have it in their wallet, the money hasn't been spent yet. Starbucks hasn't. When they sold the card to you, it created a liability on the part of Starbucks. And of course, they received the cash money, for it. But the float is the fact that it still hasn't been used yet. And so once it's used, then you can record the sale once it's used. And so this is a big problem with like gift cards and stuff, is you have this concept of float. And then what happens, you'll hear, let's say, when Kmart went under, if you have a Kmart gift card, you better, hurry up and use it. Or Sears, if you have a Sears gift card, you better hurry up and use it, because once they're gone, they're gone. So, you know, that's something just to be aware of with that. Okay, so preparing entries to account for short-term notes payable. We've talked about notes a little bit, I know already, but we'll just for review. A short-term note payable is a written promise to pay a specific amount on a stated future date within 1 year. Promissory notes can be sold or transferred. The written documentation provided by notes is helpful in resolving disputes and also pursuing legal actions against those liabilities. So against somebody that, for example, hasn't paid. Most notes payable bear interest to compensate for the use of the money until the payment is made. And they do get sold occasionally. So for example, like for us, we had our mortgage with Chase. That's who we were paying our mortgage to. Chase Bank sold the rights to that note. They sold it to another company. So now we're making our payments to another company. Same thing with student loans. That happened before with the student loans. Is the banks were involved in that at one point, federal student loans, but the banks were still involved in it. And when the bottom fell out of the economy in 08 to like 2010, the federal government, Department of Ed, stepped in and bought up a lot of those loans from the various banks. And so then they're serviced by, and are owned then by the Department of Education. So you can sell notes and the people still owe them. You know, we still owe our mortgage. I still owe my student loans. It doesn't matter who holds it. You just have to then start paying it to the person that owns it. And then whoever owned it, for example, Chase, they probably got a lump sum then for the right then of this other company to be able to have the loan and to be able to collect payments and the interest on it. So we've talked about that earlier. So again, it's a written promise to pay a specific amount of money on a stated future date within 1 year, in this case, a short-term note. Most notes bear interest, and it can arise from either from an overdue account payable or a borrowing from a bank. We see here a note that was given to extend the credit period. So on August the 23rd, Bradley Company asks McGraw to accept $100 cash and a 60-day 12% $500 note to replace its existing $600 accounts payable. So you would have a debit to the accounts payable McGraw, $600, and then credit cash $100 because they received $100 cash, and credit the accounts payable McGraw. And so a company can replace an accounts payable with a notes payable. Common example is a credit that requires substitution of an interest-bearing note for an overdue accounts payable that the accounts payable doesn't bear interest because it's supposed to be paid off within 60 days. Now, signing the note changes Bradley's debt from an accounts payable to a notes payable. McGraw prefers the notes payable over the accounts payable because one, it earns interest. Two, it is a written documentation of the debt's existence, term, and amount. And that can come in handy later if, let's say, the company goes bankrupt to have in court. So when the note comes due, Bradley pays the note and interest to McGraw of $510, and Bradley records the payment for this entry. And so again, interest expense is computed by multiplying the principal of the note, which is $500, by the annual interest rate, which is 12 for the fraction of the year the note was outstanding. So in this case, it was 60 days out of 360 days. Remember, we use 360 instead of 365 for the year. The notes payable McGraw, debit $500, and then debit the interest expense 10, and then cash for $510. Now, a bank requires a borrower to sign a note when making a loan. When the note becomes due, the borrower repays the note for an amount larger than the amount borrowed. The difference between the amount borrowed and the amount that was repaid is interest. So the amount that was borrowed would be considered principal, and then the amount in excess of that would be the interest. So principal or the face value of the note. The borrower records its receipt of cash and a new liability as shown in the first section. So on September the 30th, the company borrows $2,000 from a bank at 12% interest for 60 days. So they receive cash debit $2,000 and then notes payable liability for $2,000. Now, when principal and interest are paid, the borrower records the payment as shown below on the second transaction we see. So November 29th, the company repays the principal of the note plus interest. So you have notes payable of $2,000 debit the interest expense of $40, and then credit cash for $2,040 because they're paying out. Okay. Now, when notes extend over 2 periods, when the end of an accounting period occurs between the signing of a note payable and its maturity date, you have to record the accrued but unpaid interest on the note. And so that is an adjusting entry that is made. Assuming that a company borrows $2,000 cash on December 16th and 19th, this 60-day note matures on February the 14th of 2020. The company's fiscal year ends on December 31st. Thus, we need to record interest expense for the final 15 days of December. So we still have to account for those 15 days in December. This means that 1/4 or 15 divided by 60 of the $10 total interest is an expense for the year 2019. The borrower records this expense assuming no reversing entries were made when the following entry as shown first. So again, on December 16th, the company borrows $2,000 per bank at 12% interest for 60 days. Adjusting entry is needed on December 31st. So December 31st of 19, you have interest expense of $10 and you have a debit and then credit for interest payable $10 because that creates a liability. The payable goes into the next accounting period, so that goes into January. The expense stays with what's going on in 19, and that's why we do that. Now, when the note is paid then on February the 14th, the borrower must recognize 45 days of interest for the year 2020 and then remove the balances for the two liability counts shown on the second. So on February the 14th, the company repays the principal and the interest on the note. And so we see that we have a debit to interest expense of $30, and that encompasses the amount of interest that is done in 2020. So January through to the 14th of February. Okay. And then we have interest payable debit of $10. That reverses, that cancels out what we did in the first one, because remember the payable liability goes into the next year. And then we have a debit to notes payable for $2,000 because that is the amount that of the note was for, the liability was. And then we'll credit cash the amount of $2,040 because that's the amount that we're paying to the bank. So now we're going to talk a little bit about payroll. So compute and record the employee payroll deductions and liabilities. So this is a section that is deducted from the employee's paycheck from their wages. So payroll liabilities arise from salaries and wages earned from employee benefits and from payroll taxes levied on the employer. Again, to kind of understand how this works, okay? Gross pay is the total compensation an employee earns, including wages, salaries, commissions, bonuses, and any compensation earned before deductions such as taxes. So remember that the gross pay is the amount that is due for, like, usually the hours that they earn, or maybe somebody is paid maybe $2,500 every month. The gross pay is that before any deductions. Okay. So then we have to figure out then the deductions. So again, wages usually refer to payments to employees at an hour. It could be an hourly rate. Some people are paid hourly. Some people are paid, like for me, teaching for the college, I'm paid an hourly rate based on how much time I would ordinarily spend in the classroom. But But then there's some people that are paid a salary. So for example, our president of our college, Chris Vitelli, because he's in management, he's paid a salary. So he gets paid the same amount. It doesn't matter if he works 40 hours that week, if he works 60 hours that week, it doesn't matter. He's going to get the same amount every week, you know, and then of course every month. It doesn't matter how much time you spend. If he spends 33 hours one month or 1 week, doesn't matter. Okay. So that's, you know, some people are paid on a salary basis. Some people are paid hourly. Net, and then salary, as I say, is the payment to employees for a monthly or a yearly rate. So some people might get paid, I don't know, say $150,000 a year. Okay. Some people might get paid $50,000 a year. Okay. So it doesn't matter on how many hours they work. So that's a salary. Now, remember, net pay is also called take-home pay. So for you as an individual, the net pay is the part that you're really interested in, because that's what you're actually going to get to bank, and then what you're actually going to get to use then to buy groceries and gas and mortgage and all of those kind of things. Okay, is the take-home pay. So that is the gross pay less all of your deductions. Payroll deductions, commonly called withholdings, are the amounts that are withheld from the employee's gross pay, either required or on a voluntary basis. Required deductions result from laws and include income taxes and Social Security. So we have to take income taxes out. We have to take Social Security out, for example. Now, there could be voluntary deductions, which are at the employee's option. Those could include pension and health contributions, health and life insurance premiums, union dues, and charitable. So, for example, shouldn't be so honest, but with me, I have money taken out of my check from the college. Part of it goes into a 403B, which is a retirement account. Part of it also goes into CalSTRS, which is part of retirement. And then part of it also have money taken out for a charitable donation, because I help with the food pantry that we have on campus. So part of it gets taken out, you know, for that. Union dues, I'm part of the union, they take out, you know, money for that. Okay. So those are all what they would consider voluntary, but there's certain things that have to be done on basis of law. So Social Security taxes, income taxes would be example. Employee FICA taxes, and FICA stands for Federal Insurance Contribution Act. And so there's two different pieces to this. And so this would be for Social Security and Medicare. And so you always hear that, you know, that you're having money taken out for Social Security and for Medicare. Okay. You can't escape either of these. This is something that has to get taken out of your check, unless you have some other situation. So I know sometimes, like students, if you work for the school, they may be able to not do this. If you're working like as a student worker under like work study, you may or may not see this, but most employers, you'll see this. So employers withhold what they call Federal Insurance Contribution Act, or FICA taxes, from employees' pay. FICA taxes are separated into two groups: either Social Security taxes, which are the wages that are meant to help cover retirement, disability, and survivorship, and Medicare taxes, which help to pay for medical benefits. And so they're medical benefits for when you retire. Law requires employers to withhold FICA taxes from each employee's salary or wages on each payday. So each check, you'll see this. If you look at your statement, you'll see this listed out. The taxes for Social Security and Medicare are computed separately. And so, for example, in 2018, the amount that was withheld from each employee's pay for Social Security tax is 6.2% of the first 128,400 of employees' earnings in that calendar year. And the Medicare tax is 1.45% of all amounts of employee earns, and there's no maximum limit for Medicare. So Social Security, they're only going to tax you up to 128.4, at least as of 18, that's what they did. But Medicare, you're going to be taxed on all of your earnings. So if you make more than that, you're going to be taxed on all of your earnings. Now, 0.9% additional Medicare tax is imposed on employees for pay when it exceeds $200,000. This additional tax is not imposed on the employer. And so usually what happens is, usually on this, the employee pays part of it, and and I think that's what they're talking about here. So the 6.2 is what's taken by the employer for the employee. The employee pays part of it, and then also the employer pays part of it. So we're talking about just a portion for the employee, what's taken out. And again, the funds are withheld, and they have to be remitted to the Internal Revenue Service, the IRS. Now, most employers withhold federal income tax from employees' paychecks. The amount withheld is calculated based upon tables that are published by the IRS. The amount depends on the employee's income and the number of withholding allowances the employee claims. For example, and on the allowances, you can figure out it's not necessarily based on how many people it is, and it isn't based on how many people you have that you support. So it could be, so like for me, I claim 0 withholding, so they take out more taxes. The lower the number of withholdings, the more taxes are taken out of each check. So the amount depends upon the employee's income and withholding allowances that the employee claims. Allowances reduce the amount of taxes one owes to the government. Whatever's withheld, that reduces what you'll owe when you go to file your taxes. So the more withholdings one claims, the less tax the employer will withhold. So if you claim, let's say for yourself 1, they're going to take out less tax from your check. Most state and local governments require employers to withhold income taxes from employees' pay and to send them promptly to the proper government agency. So you have, for example, federal income tax that they have to remit that to the IRS. You also, in our state, we have state California income tax, so they have to remit that to the state franchise tax board for California. And then some places have, which we don't here, but it would go under like the state disability, would be like a local income tax. Okay, I read that. Until they are paid, withholdings are reported as a current liability on the employer's balance sheet. So the employer owes this until they cut the check to either the state or the federal or wherever the taxes are owed to. And that can get a company in a lot of trouble if they are not paying this. So employee voluntary deductions, the amounts withheld depend on the employee's request. So beyond Social Security, Medicare, and income taxes, employers often withhold other amounts from employees' earnings. These withholdings come from employee requests, contracts, unions, and other agreements. They could include amounts for charitable giving, medical and life insurance premiums, pension contributions, and union dues. Until they're paid, such liabilities are reported as part of an employer's current liability. See an example here of how we would record that. And so employers must accrue payroll expenses and liabilities at the end of each pay period. To illustrate, assume that an employee earns a salary of $2,000 per month. At the end of January, the employer's entry to accrue payroll expenses and liabilities for this employee. Salaries expense debit shows that the employee earned a gross salary of $2,000. The first 5 payable credits show liabilities the employer owns on the behalf of the employer to cover FICA taxes, income taxes, medical insurance, and union dues. The salary payable account credit records the $1,524 net pay, which is what the employer receives of the $2,000 gross pay. The entry to record cash payment is a debit to salaries payable and then a credit to cash in the amount of $1,524. So we see salaries. The first part of this is to record the payroll expenses and deductions for the employee. You would debit $2,000 salary expense, and then you would then credit the FICA, which is the Social Security tax payable, the Medicare tax payable, employees' federal income tax payable, employee medical insurance payable, and union due payable, and then credit salaries payable $1,524. And then when you go to actually record the actual cash payment, then would be So January 31st, that is the last day that they worked, and then February 1st is payday. So then you would record salaries payable 1524. We get that from up here, and then we would credit cash 1524 because we're paying out. We're usually writing a check to the employee. Compute and record the employer payroll expenses and liabilities. Employers must pay payroll taxes in addition to those required of employees. Employer taxes include FICA and unemployment taxes. Employers must pay FICA taxes on their payroll to employees. For 2018, the amount employers must pay Social Security taxes of 6.2% on the first 128,400 earned from each employee, and 1.45% Medicare tax on all earnings from each employee. And employer's tax is credited to the same FICA tax payable accounts that were used to record the Social Security and Medicare taxes withheld from employees. A self-employed person has to pay both the employer and the employee portion of the FICA. So in this case, as I say, what's withheld is split half to the employee, half to the employer, but it equals 6.2% for Social Security, 1.45 for Medicare for either side. Okay, and then also the employer would also have to deduct federal and state unemployment taxes as well. Now, the federal government works with states in a joint federal-state unemployment insurance program. Now, each state administers its program. These programs provide unemployment benefits to qualified workers. The federal government approves state payments and pays a portion of their administrative expenses. And so you have the Federal Unemployment Tax Act, or FUTA. That is, the employer is subject to a federal unemployment tax on wages and salaries earned by their employees. For the current year, employers were required to pay FUTA taxes of as much as 6% of the first $7,000 earned by each employee. This federal tax can be reduced by a credit of up to 5.4% for taxes paid to a state program. As a result, the net unemployment tax is often only 0.6%. Now, State Unemployment Tax Act, or SUTA. All states fund their unemployment insurance program by placing a payroll tax on employers. Now, a few states require employees to make a contribution. California is not one of them. So the employer pays. The employee doesn't pay anything for it in California. Now, in our assignments and questions in our textbook, we assume that the tax is only going to be on the employer. So we're not going to worry about the employees won't have to worry about it in our book assignment. Now, in most states, the base rate for SUTA tax is 5.4% on the first $7,000 earned by an employee. This base rate is adjusted according to the employer's merit rating. The state assigns a merit rating based on the company's stability in employing workers. A good rating reflects stability in employment. It means an employer can pay less than the 5.4% base rate. A low rating reflects high turnover or seasonal hiring and layoffs. And so it's important to note, because I see this a lot, and I read this a lot on Facebook and stuff, people were complaining about the unemployment and that they're not getting it, and they think that as an employee that they pay for it. The employee does not pay for unemployment. It is based on the employer. And employers will do a lot of things in order to fight to not pay unemployment, particularly if there's a situation where the person should not be paid unemployment, so that to reduce that merit rating, because that merit rating affects how much the employer has to pay. Reporting the employer portion of the payroll taxes. So employer payroll taxes are an added expense beyond the wages and salary that are earned by the employee. These taxes are often recorded in an entry separate from the one recording payroll expenses and deductions. To illustrate, assume that the $2,000 recorded salary expense from the previous example is earned by an employee whose earnings have not yet reached $5,000 for the year. This means that that entire salary expense for that period is subject to tax because the year-to-date pay is under the $7,000 amount. Also assume that the federal unemployment tax rate is 0.6% and the state unemployment tax rate is 5.4%. Consequently, the FICA portion of the employer's tax is $153 computed by multiplying both the 6.2% and the 1.45% of the $2,000 gross pay. Moreover, state unemployment or SUTA tax is $108, and that's 5.4 multiplied by 2,000 gross pay, and the federal unemployment tax or FUTA tax is 12, so that's 0.6 multiplied by 2,000. So the entry to record the employer payroll tax expense and related liability is shown. And so we see here that on January the 31st, which is the last working day in that pay period, you have payroll tax expense of $273 debit. So you have a credit of $124 for FICA, the Social Security tax at 6.2%. And then we have a credit the amount of $29 for FICA, Medicare payable, 1.5%. And then we have state unemployment tax payable or SUTA of $108 credit, and then a credit for federal unemployment tax payable or FUTA for $12. And remember again that the FICA amounts for both the Social Security and the Medicare are going to be the same as what was withheld from the employee gross pay. Internal control of payroll. Internal controls are crucial for payroll because of a high risk of fraud and error. The 4 key areas that should be separated and monitored, including employee hiring, payroll preparation, timekeeping, and payroll payment. Multi-period known liabilities. Many known liabilities extend over multiple periods. These often include unearned revenues and notes payable. So for example, if Sports Illustrated magazine sells a 4-year magazine subscription, it records amounts received from this subscription in an unearned subscription revenue account. Amounts in this account are liabilities, but are they current or long-term? They actually are both. The portion of the unearned subscription revenue account that will be fulfilled in the next year is a current liability. The remaining portion is reported as a long-term liability. The same analysis applies to notes payable. For example, a borrower reports a 3-year note payable as a long-term liability in the first 2 years that it's outstanding. In the 3rd year, the borrower reclassifies that note as a current liability since it's due within that 1 year, the last year. The current portion of long-term debt refers to the part of long-term debt that's due within 1 year. Long-term debt is reported under long-term liabilities, but the current portion due is reported under the current liability. Now, some known liabilities are rarely reported in long-term liabilities, and so that would be accounts payable, sales tax payable, and wages and salaries. Those would not be included as part of a long-term liability. Account for estimated liabilities, including warranties and bonuses. So estimated liabilities. An estimated liability is a known obligation that is of an uncertain amount, but can be reasonably estimated. Current examples are employee benefits such as pensions, healthcare and vacation pay, and warranties offered by a seller. We'll discuss these in this section. So, for example, vacation pay, somebody earns that throughout the year, and maybe depending upon maybe it could carry forward possibly into that next year, although a lot of places don't like to do that. They want you to use it within that current year because it does create a liability. But they can estimate it, but they don't necessarily, it could vary based upon the number of hours that people work and that kind of thing. Warranties would be another thing. You don't know the expenses that are going to be incurred on that. So, for example, I had to buy a washing machine and it came with a 1-year warranty. And of course, I bought an extra 5-year warranty on top of that. Well, they don't know. I may have this silly thing for 6 years. They may never have to come and work on it. Or it could be like my dishwasher, where it's a good thing I bought that extended warranty because they've worked on it twice, because there was a part in it and it was the same part that they had to replace twice. So, I mean, they don't know. So for a warranty, they wouldn't know necessarily what the expenses are, but they can estimate that. And so we'll talk about that. So health and pension benefits, employer expenses for pensions or medical, dental, life, and disability insurance. So many companies provide employee benefits. An employer often pays all or part of medical, dental, life, and disability insurance. Many employers also contribute to pension plans, which are agreements by employers to provide benefits or payments to employees after retirement. Many companies also provide medical care and insurance benefits to their retirees. And so to illustrate, assume that a company agrees to pay $8,000 for medical insurance and to contribute an additional 10% of an employee's $120,000 gross salaries to a retirement program. The entry to record these accrued benefits are shown. And so on December 31st, you have employee benefit expense of $20,000 debit, and you have to credit the employee medical insurance payable of $8,000 and medical employee retirement program payable for $12,000, because they have that. They won't pay it until maybe January or at some other point in time, but they have to, so it creates a liability for the company. Vacation pay. Many employers offer vacation benefits, also called paid absences. Vacation benefits are estimated and expensed in the period when employees earn them. Assume that salaried employees earn 2 weeks paid vacation per year. The year-end adjusting entry to record 3,200 of accrued vacation benefits is shown as the first journal entry. In order to show then that it's earned, you would have a debit to the vacation benefits expense of 3,200, and you have a credit to vacation benefits payable for 3,200. That's showing what happens once the vacation is earned. Now, vacation benefits expense is an operating expense. Vacation benefits payable is a current liability, because we hope that they would take their vacation within when an employee takes a 1-week vacation, the employer reduces or debits the vacation benefit payable, credits cash. This is shown as a second entry on this slide. So once it's actually taken by the employee and paid out, you have a debit to vacation benefits payable of $400 and then a credit to cash for $400, because that reduces the liability for vacation benefits by $400, and it also reduces the amount of cash by $400, because we're now paying that out to the employee. Bonus plans. Most companies offer bonuses to employees, and many of the bonuses depend upon net income. Let's assume that an employer offers a bonus to its employees equal based upon the company's annual net income to be equally shared by all. So the profits get shared by all. So the year-end adjusting entry to record a $10,000 bonus is shown. So you have an employee bonus expense of $10,000 and then a credit to bonus payable for $10,000. Again, it's a liability because they haven't paid it out yet, and they'll pay it out when they get their first check, in this case in January, then they would pay it out. Warranty liability. A warranty is a seller's obligation to replace or to fix a product or service that fails to perform as expected within a specified period. So for example, most new cars are purchased and they have a warranty, and they're sold with a warranty that cover parts for a specific period of time. So for example, if I was looking at this, funny thing, I was looking at this last night. I was looking at the owner's manual for my car, looking at something for service intervals, so something else. And I was like, look at that. So when my car was brand new, it had a 3-year or 36,000 mile warranty. Now there's some cars like Hyundai that have like a 10-year, 100,000 mile warranty. So it depends upon obviously the type of vehicle that you have, okay? But they will fix whatever it is if it's due to something on their part for 3 years, in my case 3 years or 36,000 miles, okay? And usually people will buy, they usually get sold another warranty on top of that, which I did. Because I bought a used car. Seller reports the expected warranty expense in a period when revenue for the sale of the product or service is reported. The seller reports this warranty as a liability, although the existence, amount, payee, and the date of the future payments are uncertain. This is because such warranty costs are probable and the amount can be estimated using, for instance, past experience with warranties. But they don't necessarily know exactly that on this car they're going to have to do, they're going to have to replace the transmission, and that's going to cost them under warranty, and that's going to cost them $3,600 or something. They don't know that necessarily at this point, but they can estimate it. They can get a fair idea. Let's look at an example. So to illustrate, a dealer sells a used car for $16,000 on December the 1st of 19 with a maximum 1 year or 12,000 mile warranty covering parts. Now, this dealer's experience shows that warranty expense averages about 4% of a car's selling price, or in this case, $640, because 16,000 multiplied by 4%. So the dealer records the estimated expense and liability related to the sale in the first entry. This entry could also be made as part of the end of period adjustments. Either way, the estimated warranty expense is reported on the 2019 income statement and the warranty liability on the 2019 balance sheet. Talk about the second part there. So we see that on December 1st, a car dealer sells a car for $16,000 with a maximum 1 year or 12,000 mile warranty coverage for parts. And so again, the past experience indicates that warranty expense would be 4% of the car's selling price. So we have a debit to warranty expense for $640 and then a credit to the estimated warranty liability for $640. So that estimates about what we think we're going to have to spend. Okay. Now, to further extend this example, suppose that a customer returns the car for some kind of a warranty repair on January the 9th of 2020. The dealer performs this work by replacing parts that cost $200. So, and it only covered parts. It didn't cover the labor. The customer still has to pay for the labor in this case. So the entry is to record the partial settlement of the estimated warranty liability is shown in the second entry. And so we see then that when the person brings back the car, the dealer replaces the parts that cost $200. Let's say the starter on the car and it was $200, let's say, for discussion. So they have a debit to the estimated warranty liability for $200 and then credit the auto parts inventory for $200. And the reason for that is you debit the liability because that reduces the amount of liability that's there. And then you have to credit the auto parts inventory because that reduces the inventory in the auto parts that they have in the service center. This entry reduces the balance of the estimated warranty liability. Warranty expenses was previously recorded in 2019, the year the car was sold with the warranty. Finally, what happens if the warranty expense are more or less than the estimated 4% or $640? The answer is that management should monitor actual warranty expenses to see whether the 4% rate is accurate. If experience reveals a large difference from the estimate, the rate of current and future sales should be changed. Differences are expected, but they should be small. Contingent liabilities. A contingent liability is a potential obligation that depends on a future event arising from a past transaction or event. An example is a pending lawsuit. Here, a past transaction or event led to a lawsuit whose results depend on the outcome of the suit. Future payment of a contingent liability depends on whether an uncertain future event occurs. Accounting for contingent liabilities depends on the likelihood that a future event will occur and the ability to estimate the future amount owed if this event occurs. Three different possibilities are identified in the following chart. Record liabilities with a journal entry disclosed in notes in a financial statement or no disclosure. The conditions that determine whether the three events possibilities follow. So either to record the liability is if the event is probable or likely and the amount owed can be reasonably estimated. Example would be warranties, vacation pay, and income taxes. You could disclose in the notes if the event is a reasonable possibility could occur, but it's not necessarily likely. We don't necessarily know, but we know that it's reasonable possibility. Or no disclosure, being that the future event is remote or unlikely. If a future event is reasonable, probable, or could occur, we would disclose the information for this type of a contingent liability in the notes to the financial statements. Two common examples of are potential legal claims resulting from lawsuits made against the company and debt guarantees. When a company guarantees the debt of an affiliated company, it may eventually have to pay the obligation. If the original debtor fails to pay, the obligation becomes the responsibility of the guarantor. You could also have other contingencies, could maybe include environmental damage, possible tax assessment, insurance losses, or the results of government investigations. And anything dealing with these, you would just report them as a note to your financial statement so that your investors and your managers, they knew what was happening. All organizations face uncertainties from future events such as natural disasters and new technologies. These uncertainties are not contingent liabilities because they are future events not arising from past transactions. Consequently, they are not disclosed. In fact, I know there's a question on the homework regarding that. Anything dealing with the threat of natural disaster or the threat of new technology, it's not due to past transactions, so you wouldn't report it. So for example, kind of a funny, silly example, but I've been watching on YouTube, there's some people in Virginia that own a laundromat, and they're near a river. And this river, it has flooded and it has come up, not quite into their place, although I think it has in the past before they owned it. But it's come up to their sidewalk, you know, almost not quite to the door because the door is raised a little bit, but it's come up almost to the sidewalk in front of their laundromat. Well, that would be due to a natural disaster. They would not report it because it didn't as a contingency to their financial statements because it's not something that is due to a past transaction. But if this river floods and it floods out their place and then they have to replace all of their machines and their flooring and part of the wall, then you know that's on them, and obviously that's a big deal, but it's not something that you'd have to report because it's not something that arose from past transactions that had happened. The times interest earned ratio, and we'll use it to analyze liabilities. Interest expense is often viewed as a fixed expense because it usually does not vary as a result of short-term changes in sales or other operating activities. While fixed expenses can be good when a company is growing, they do create risks. The risk is that the company might be unable to pay fixed expenses if their sales decline. So again, kind of thinking about the laundromat example of the people in Virginia, they own this laundromat on YouTube. Let's say that because of the coronavirus, they had to close down their laundromat. It wasn't deemed essential. Laundromats are deemed essential, so they're still allowed to be open even though A lot of other things, of course, we know, like hair salons and things like that were shut down due to the coronavirus. Let's say that they were shut down. Well, obviously, if they were shut down, they were not earning revenue. People weren't coming in, using the machines, using the vending, etc. there. But they still have to pay rent. They still have to pay, even though they're not using water, they still have to pay the water bill. They're not using the lights and the electricity, but they still have to pay the electricity, the gas, etc., even though they're not using those things. So that would be an example of a fixed expense. And that would be an issue for them if they were not making sales. So companies that own money to a business want to be assured that the principal and interest will be paid when it's due. One measure that helps creditors assess the risk of a loan is the times interest earned ratio. And we calculate the ratio by dividing the income before interest and income taxes by the interest expense. Income before interest and income taxes is sometimes referred to as operating income. And we've talked about that, I know, before. Interest times interest earned equals the income before interest and taxes divided by the interest expense. So let's look at an example. Consider Diego Company results for 2019 and two possible outcomes for the year 2020 that are shown in figure 11.6. It's in the first portion of the screen here. Now, expenses excluding interest are expected to remain at 75% of sales. Expenses that change with sales volume are considered variable expenses. Interest expense is fixed at $60 per year. So the sales increase column in Exhibit 11.6 shows that Diego's net income increased by 63% to $165 million, and sales increase, net income increases by, if sales increase by 50% or 900 million. The sales decrease column shows that net income decreases by 83% if sales decline by 50%. These results show that the amount of fixed interest earned affects the company's risk of its ability to pay interest. One measure of ability to pay is this ratio that we talked about that is shown in figure 11.7. So for 2019, Diego's times interest earned is computed as 150 divided by 60, or 2.5 times. This ratio means that Diego has a low to moderate risk because its sales must decline sharply before it is unable to pay its interest expenses. If times interest earned falls below around 1.5, a company will likely be at risk of not being able to pay for its liabilities. But 2.5, that's pretty good. But if it goes, but if it goes below 1.5, then the company is at risk of not being able to meet its obligations. Identify and describe the details of payroll reports, records, and procedures. So this appendix focuses on payroll accounting and its reports, records, and procedures. So payroll reports. Most employers and employees and employers are required to pay local, state, and federal payroll taxes. Payroll expenses involve liabilities to individual employees, to federal and state governments, and to other organizations such as insurance companies. Employers are required to prepare and submit reports explaining how they compute these payments, reporting FICA taxes and income taxes. The Federal Insurance Contribution Act, or FICA, requires that each employer to file an Internal Revenue Service IRS Form 941, the employer's quarterly federal tax return, within 1 month after the end of each calendar quarter. So every 3 months, this gets filed. Accounting information and software are helpful in tracking payroll transactions and reporting the accumulated information on Form 941. Specifically, the employer reports total wages subject to income tax withholding on line 2 of Form 941. Federal depository banks are authorized to accept deposits of amounts payable to the federal government. Deposit requirements depend on the amount of tax owed. For example, when the sum of FICA taxes plus the employee income tax is less than $2,500 for a quarter, the tax can be paid when Form 941 is filed. Companies with large payrolls are often required to pay monthly or even semi-weekly. Report itself gets filed every quarter, but sometimes they have to remit payment either monthly or semi-weekly, depending upon the pay period and how that is done, based on the size of the company and the size of the payroll. Now, reporting FUTA taxes and SUTA taxes. An employer's federal unemployment tax, or FUTA, are reported on an annual basis by filing an annual federal unemployment tax return, or an IRS Form 940. It must be mailed on or before January 31 following the end of each tax year. 10 more days are allowed if all required tax deposits are filed on a timely basis and a full amount of tax is paid on or before January the 31st. FUTA payments are made quarterly to a federal depository bank if the amount due exceeds $500. If $500 or less is due, the taxes are remitted annually. Requirements for paying and reporting state unemployment taxes, or SUTA, vary depending upon the laws in each state. Most states require quarterly payments and reports. Reporting wages and salaries. Employers are required to give each employee an annual report of his or her wages subject to FICA and federal income taxes, along with the amounts of those taxes withheld. This report is called the wage and tax statement, or as we know it, a Form W-2. And it has to be given to employees before January the 31st following the year covering the report. And so they have to give us that. And of course, we use that when we go to file our IRS 1040 to file our taxes. We have to use information. And if we mail the actual tax return in rather than using software to e-file the return, we actually have to include a copy of that with it. Now, payroll records. Employers must keep payroll records in addition to reporting and paying taxes. These records usually include a payroll register and an individual earnings report for each employee. And so sometimes this can be done on paper. Usually this is done either through QuickBooks or done through a service such as ADP or Paychex or something like that. Usually assists us in preparing these records and also in doing the reports and in writing checks and all of that. Now, computing federal income taxes. To compute the amount of taxes withheld from each employee's wages, we need to determine both the employee's wages earned and the employee's number of withholding allowances. Each employee records the number of withholding allowances claimed on a withholding allowance certificate or Form W-4 that's filed with the employer, filed with the employer. So when you're hired, you fill out a Form W-4, and then if you need to change your withholdings, you would go to the payroll department and you would fill out a new W-4. When the number of withholding allowances increases, the amount of income taxes withheld decreases. So again, the higher the withholding allowance amount, the lower the amount of taxes. I know that seems odd, but that's how that is. Now, employers often use a wage bracket withholding table to compute the federal income tax withheld from each employee's gross pay. Corporate income taxes and how that works, because that's another type of liability that companies have. So income tax liability. Corporations are subject to income taxes and must estimate their income tax liability when they are preparing financial statements. Since income tax expenses are credited by earning income, a liability is incurred when income is earned. This tax must be paid quarterly under federal regulations. So for businesses, they pay it quarterly. To illustrate, consider a corporation that prepares monthly financial statements. Based on its income in January, this company estimates that it owes income taxes of $12,100. the first adjusting entry records this estimate. So we see that on January the 31st, we have an income tax expense of $12,100 debit, credit to the income tax payable of $12,100, which is to liability. So we debit the expense, credit the liability. Now, the tax liability is recorded each month until the first quarterly payment is made. If the company's estimated taxes for this first quarter equal $30,000, the entry to record its payment is shown second. So we see on April the 10th, we have a debit of the income tax payable, which is the liability for $30,000. We'll credit cash for $30,000. And so that is showing the payment of the first quarter of corporate income taxes. This process of accruing and then paying estimated income tax continues through the year. When annual financial statements are prepared at year end, the corporation knows its annual total income and the actual amount of taxes it must pay. This information allows it to properly record income tax expense for the fourth quarter so that the total of the fourth quarter equal the amount of taxes that were actual taxes paid to the government. Now, assume that in recording its usual quarterly income tax payments, the corporation computes $25,000 of income tax expense. It also determines only $21,000 is currently due, $4,000 is deferred to future years, a timing difference. The entry to record this end of period adjustment is shown. The credit to income taxes payable is the amount that's currently due to be paid. The credit to deferred income tax liability is tax payment that were deferred until further years when the temporary difference reverses.